Good evening, everyone. Time for another silver update. You're looking at the 5-minute chart of spot silver on NetDania. I wanted to address a number of issues that have been raised regarding my previous videos and specifically this volume spike sell-off that we had. And the critics have brought up a number of points, and I'm not really interested in answering critics because really, for the most part, the things they have to say are irrelevant and nonsense and personal attacks and things like that. I'm not interested in wasting my time because I'm much more interested in educating people as to how markets work and how silver is an incredible buy, that physical silver is something that's a once-in-a-lifetime opportunity at these prices. But I wanted to address the three major issues that have been used as criticisms of this analysis that I've been doing lately. So let's jump in real quick and hopefully I can explain. Some of these concepts are extremely complicated to explain. They're really not that complicated when you grasp them intuitively, but at first they can be very daunting because they don't come easily. But if you think about them, they come pretty quickly if you think about them deeply. So the first criticism I want to deal with is the idea that this is a false tick, this volume spike I documented in my video 2 days ago. I don't believe it's a false tick. I think exactly what I said in my analysis was true, is that it was a front run sell-off by the powers that be and a subsequent recovery, and we're trading kind of halfway through. And the point I wanted to address first is this volume that we have here. So you can see we're on the 5-minute chart, which gives us a 40 plus 50,000 on that spike. You can see that the price move is commensurate with the volume move. Now, a lot of people said, well, that's a bad tick. No, it's not a bad tick. Just like that's not a bad tick. So let's examine these spikes right here, and we'll pull out to the 1 minute, and you can see them right here. So you've got the beginning of today's sell-off occurred at a volume of 4,000. So let's examine 4,000. Remember, we're at 5,000 ounces per contract, and 4,000 is 20 million ounces, and we had that hit once, nearly twice, 3/4 there, above again and again, and nearly again there. So that's 20 million ounces traded in these time frames. So remember, the US only mines 50 million ounces a year. This is the volume of the paper that's going on. So they're not bad ticks, they're just what's going on in the market, and that's pretty much enough to put that to bed. But the other issue I want to address is the confusion that people have about why I describe this as 50,000 contracts being sold. So we're going to have to pull out a little bit to understand that, and actually we'll go out a little bit more to the 30. Now, it's not really hard to figure out, because when you have a spike, and that spike, we'll start with this spike here, corresponds with volume, then you pretty much know what the basis of that spike is. So the spike we're looking at right here is obviously buying, for the most part, buying volume, as this spike was selling volume, and this spike was selling volume. So the way you determine what the main interest of this price move is you line up the volume with the price and see where it went. And the criticism and the difficulty that most people have in understanding how markets work is they talk about how, well, you said that was selling or you said that was buying. Well, every time there is a trade, there's the same number of buyers and sellers. So I'll quote you a person that was a president of a trading firm that I worked for, and a running argument on the floor was, someone asked the question, why is the price falling? And the answer was, because there are more sellers than buyers. And the immediate answer was, no, there's always the same number of sellers as there are buyers. So the retort was, actually, okay, you're correct, but the sellers are more aggressive than the buyers. And that was the explanation given. So this is even a conundrum for brokers and traders, but really that explanation is not true either. The first explanation is more accurate. When you say there are more sellers than buyers or buyers than sellers, really all that means is that at a given price, there's a lot of people who want to buy. So when you have a breakout like this one you have right here, you might have, just pick a number, 5,000 people who want to buy and get in. But you have previous owners of that contract who are willing to sell at that price. They put stop limit orders in. But there's a whole bunch of people who want to buy, and as the price rises, it finds the sellers that already exist, but then there aren't enough of them, so the price continues to rise to find more sellers. And of course, as it rises, some of these buyers become less aggressive because they are willing to buy at 37, say, but when it gets to 38, they're not interested in buying anymore. They're going to wait till it's cheaper. So these are constant dynamics that change, and it's not simple to understand, but you have to understand that as new buyers or as new sellers come into the market, the dynamics of supply and demand make price what it is. So price is always determined by supply and demand. Don't be thrown off by the fact that at any given trade there's the same number of buyers and sellers. But the price has to move based upon the pressure. If there's a greater number of buyers than sellers, then the pressure of that, if they continue to be as aggressive, will drive the price up as it finds new sellers, but not enough, and it goes higher and higher. Same thing works on the other side. If someone comes in and dumps, say, or telegraphs that they're going to dump 50,000 contracts, let's go to the 5-minute. If it's known that someone's going to dump 50,000 contracts, then you're going to have to go down and down and down and down and down to find enough buyers to fill that. Obviously, all the way down and all the way back up, the same number of buyers and the same number of sellers always match each other. But price is determined by this pressure. So it's the pressure of buying and selling. Now, the other issue that has been brought up about this video that I did about the sell-off on this 50,000 ounces is the idea of open interest. And open interest is a real mystery to a lot of people, so I wanted to delve a little bit into an explanation of open interest and what it is. Now, this is a Wikipedia article. I'll go ahead and link this, and it is a little bit confusing because it talks about contracts and options, but let's start with the definition. Open interest, also known as open contracts or open commitments, refers to the total number of derivative contracts like futures and options that have not been settled in the immediately previous time period for a specific underlying security. A large open interest indicates more activity and liquidity for the contract. For each buyer of a futures contract, there must be a seller. From the time the buyer or seller opens the contract until the counterparty closes it, that contract is considered open. So that's the basic definition, and to understand why that's important, we'll go down to their analysis of the benefits of monitoring open interest. By monitoring the changes in open interest figures at the end of each trading day, some conclusions can be drawn about that day's activity. Increasing open interest means that new money is flowing into the marketplace. The result will be the present trend up, down, or sideways will continue. Now that's confusing. So the present trend could be any one of those three, and it will continue. So what does it mean to say that a sideways trend will continue? So we'll come back to that. But declining open interest means that the market is liquidating and implies that the prevailing price trend is coming to an end. A knowledge of open interest can prove useful toward the end of major market moves. A leveling off of open interest following a sustained price advance is often an early warning of the end of an uptrending or bull market. So that's a brief explanation of what open interest is, and it's very confusing for people. So one of the criticisms that I received was that this spike could not have occurred because open interest would have drastically changed if this was a true sell-off. And what I want to point out is why that's not the case. So what I created was a little spreadsheet here, and I'm going to explain that to you briefly. The first column here is the volume of the futures contract. The second column is existing contracts sold. That means futures contracts that already exist. They are part of the open interest. The third column is existing contracts bought. Those are also existing contracts, part of the open interest that already exists. New contracts created are when a position is initiated, but the opposing party is someone who has to create a new contract to bring this into existence. And this column is when existing contracts are extinguished from existence by either a buy or sell order. And the last column is a change in open interest. So hopefully, and the variables, I did not draw out all the possible positions because I don't even know what they are. I guess you would have to use an exponential calculation of all these variables to determine what's possible with the volume, and I can't calculate that. But I just threw a bunch of scenarios in here so you can see. Hopefully this will help you understand how open interest works. So the first scenario is we have a volume, and you'll note that all of these scenarios have a volume of 70,000. So I want to remind you, the reason I'm bringing this up is because of the criticism that the volume that I cited couldn't be valid because there would have been a change in open interest. And I'm trying to prove that that's not the case. So the first scenario that we've got here is 70,000 volume, and you can see when we look at this is today's volume, we actually have an open interest of 59,000 contracts on the SIU, the open silver. The most nearby frequently traded futures contract in silver is the September silver contract. And the open interest is 59,000 at the end of trading today. The volume in that contract is 70,000. So the first thing you want to note is that the volume is higher than the open interest. Now that's puzzling if you don't understand open interest. So let's go back to our chart. So our first scenario, using that 70,000 figure, let's say that we traded a volume of 70,000 contracts. And that volume consisted of 35,000 existing contracts sold. Those were open futures contracts that had been opened before. They were sold. And we have 35,000 existing contracts bought. So in that case, we didn't have any new contracts created. We didn't have any existing contracts extinguished, so the change in open interest is 0. So let's go to our next scenario. We had, again, a volume of 70,000. In this case, someone sold 70,000 existing contracts, but there were no new buyers, so there were no buyers of existing ones, so the new contracts created were 70,000. So that results in a positive change in open interest of 70,000. The next scenario is a volume of 70,000 again, but this time 70,000 contracts were bought. And no one sold them any existing contracts, so they had to create new contracts. So again, we had a change in open interest of positive 70,000. Now this next scenario is a contrast to the first one. In the first one, we had 35,000 existing contracts sold, 35,000 existing contracts bought, so no change in open interest. But in this one, we have 35,000 contracts sold and new contracts had to be created. And we also had 35,000 contracts bought and new contracts had to be created there. So we had a total of 70,000 contracts created. So we had a positive change in open interest of 70,000. The next scenario is we have 70,000 contracts, again, in volume. This time, someone sold 70,000 contracts and someone bought 70,000 contracts. But the 70,000 contracts sold were ones that already existed, and the 70,000 were bought with cash, so those 70,000 were extinguished. They went out of existence. So we had a change in open interest of negative 70,000. The next scenario, we have again 70,000 in volume. This time we have 35,000 contracts sold, existing, 35,000 contracts existing bought, but both of those were new contracts created. So when the buyers wanted to buy, they had to create a new contract. When the sellers wanted to sell, they had the other way around, sorry. They had to create a new contract. So we had 70,000 new contracts created, so that's a positive 70,000 change in open interest. And the last one is, again, we had 70,000 volume. This time, 35,000 existing contracts were sold, and 35,000 existing contracts were bought, but those were all contracts that were extinguished. So we had a change of negative 70,000. So you can see, with a volume of 70,000, given the different variables in the change of open interest, you can have nothing, and of course I could do 35. I could do any number here. This number can change based on these volume variables. So the point is that when someone initiates a position in a market, in a futures market, you might have a new buyer come in right here. If you have a new buyer come in right there, you might not have any sellers of existing contracts willing to sell at that price. If that's the case, then someone on the floor must take the opposite side of that trade and create a new contract. That causes open interest to rise. Now, if that person buys an existing contract, then open interest stays the same. But if someone sells an existing contract for cash, and the buyer is not someone who has to create that contract to take the other side, but is a person who takes it for cash, then open interest decreases. So I hope this explanation is accurate and educational, but the point I'm trying to make is that you can't look at open interest to determine anything about price as far as this move had to be this or that move had to be that. Open interest can go either way on the same volume. So when we go back to our futures numbers here, we can see that we had a volume of 70,000, but open interest is 59,000. So we can deduce from that that obviously some of this volume was the extinguishing of existing contracts. That's the only way that this number can be lower than this number. If this number were higher than this number, then we know that they created contracts that day. So that's about all you can conclude from open interest. You can't use open interest to say that this is not a legitimate trade. Half of these could have been buyers of existing contracts and half could have been sellers. All of them could have been buyers, all of them could have been sellers. Half of these could have been buyers of new and half could have been buyers or sellers of new. Or half could have been buyers of old and half could have been sellers. You don't know that information. You only know at the end of the day whether open interest increased or decreased. And we have to go back to Wikipedia to understand that generally an increase in open interest along with an increase in price is said to confirm an upward trend. So hopefully that's an explanation. It's somewhat difficult for people to understand, but there's always a buyer for every seller, but the pressure of sellers versus buyers determines the price, and the pressure of new investors versus old investors determines the change in open interest, and that's ultimately what determines price movements. And we'll talk to you next time.